Is China quietly exporting its economic problems to the rest of the world? The International Monetary Fund just issued a sharp warning, saying China's growth strategy is creating dangerous global imbalances. Is this the beginning of a new trade war cycle? Let's break down what's really happening. In its latest annual review of China's economy, the IMF delivered one of its strongest critiques in years. Why is this a big deal? For decades, China's model has been simple: produce more, export more, grow faster. But now domestic demand is weak. The property sector remains fragile. Consumer confidence is soft. Prices are falling. So instead of relying on Chinese consumers, growth is increasingly coming from foreign buyers, including the United States. And when one country runs massive trade surpluses, someone else runs massive deficits. That's when political pressure starts rising. Even economists at Goldman Sachs Group Inc. recently warned that China's expanding export dominance could become a net negative for the global economy. In other words, the imbalance isn't just statistical, it's structural. Why this matters for the US? For American viewers, this isn't abstract. A rising Chinese surplus means more pressure on US manufacturing, higher chances of tariffs increase trade friction, potential retaliation cycles. We've seen this movie before. When trade imbalances widen, Washington responds. And if tariffs escalate again, markets won't stay calm. The global risk, the IMF is worried about something deeper: deflation. When prices fall across a major economy like China, it can reduce corporate profits, slow investment, export cheaper goods globally, trigger price competition worldwide. Combine that with rising government debt, projected to exceed 135% of GDP in coming years, and the risks multiply. The IMF is essentially saying China's current path may stabilize growth in the short term, but it could destabilize global trade in the long term. What the IMF wants. The IMF is pushing for a fundamental shift. Move away from export dependence, boost domestic consumption. Support households instead of heavy industry. Allow more currency flexibility. Reduce large industrial subsidies. In simple terms, make Chinese consumers stronger, not just Chinese factories. Our conclusion of our today's discussion is that China is not collapsing, but it is at a crossroads. If Beijing pivots toward consumer-led growth, global tensions could ease. If it doubles down on export while demand at home remains weak, we could see renewed trade wars, currency disputes, global market volatility. This isn't just China's story. It's the next chapter of global economic power shifts. In the world, especially the United States, is watching closely.